Good afternoon, Wealth Our Way family. It is your man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. I'm having some technical issues. Deal with me, good people. So it says that I am live. I have to double check this now. So I think we had a little restart. So for those of you who are already watching, I apologize. I'm going to start fresh because I got a message from StreamYard stating that my connection wasn't live. So I'm gonna start over again. Hello, everybody. It is your man, Charles Tank Harris, the chief visionary officer and founder of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. Today is Tuesday, June 2nd. Not Tuesday. It's Wednesday, June 2nd. 2021. Got me all messed up today. Coming here live to talk to you today about all of the things related to the volatility in the market, whether it's going up or going down, and how that is good for you. That market trouble is good for you. Let me start by saying thank you to everyone who is live with me here on Facebook or on YouTube as we stream through StreamYard. And always a special salute and shout out to Wealth Our Way Nation, who watches 15 minutes of finance overnight, on the weekends, or wherever they can squeeze 15 minutes of financial literacy in. It has been a tumultuous start to the month of Tank. As I told you, my birthday's in a couple of days, so I'm all over the place. But as you can see by the backdrop, I'm back in the lab today and happy to be here. I'm ready to give you guys some very, very key information on market volatility and how it is actually an opportunity for those of us who have long range financial goals, which is where we all should be. If you're on this platform, if you are following Wealth Our Way, if you subscribe to all of our social media, you know that we are a long-term planning firm and we promote financial literacy. We promote your knowledge of all things financial and in every area of finances. A lot of people nowadays are becoming, as the saying goes, woke on investments, and that's great. We have to find a way to close the racial wealth gap. We have to find a way to increase the productivity of the entire country and the globe, for that matter. And understanding investments goes a long way toward that goal. However, there are a lot of other parts of finances. I have worked in this industry mainly as a planner, but I started as an investment advisor. I started as what was called a stockbroker and then became a wealth manager. What that means is that my specialty originally was in investments. So I have the licenses, the experience, and the acumen to talk about investments. But I spend a lot of my time teaching my clients and those of you who follow me here that investments is just a small part of getting your money together. The reality is that in order to invest, you have to have some money. You have to be deriving an income from something. You have to be budgeting and tracking said income to create enough discretionary income to put into investments. Sometimes that means lowering your day-to-day obligations or your current debts. So debt management is equally as important. But today, with me focusing on the market, I want to talk about how things going up and down, whether it's the cryptocurrency market, the bond market, the stock market, real estate market, it doesn't matter. When things are going up and down, it creates a lot of uncertainty in people. And when we see protracted, which means lengthy periods of downward movement, it scares a lot of people out of the markets. My hope for each of you is that you get enough knowledge and education here to not let the volatility that is going to come scare you out of the market. I gave an example the other day of my own personal holdings, and I'll reiterate that example today. It seems to be steadying out at $30 a share for this particular company. But when I first bought the company, it was trading in the high 40s. It went from the high 40s to the low 40s, from the low 40s to the mid 30s, from the mid 30s to the low 20s, and from the 20s into the teens. I believed in the company. I believed in the particular project that the company had as their main reason for existing. And I believed in the management team. I was even reading news on the company that the management team was selling their own shares, which is normally a sign that, hey, if they don't believe in the company, you got to not believe in the company. But the reality is that the more information you get, the more literacy you come and get, you have to realize certain things about why people sell, what their motivation is. In this particular instance, when I was looking at the company, I could have just jumped on the first article that I said, and newspapers, media broadcasts, you have to know why they're in business. They're not in business necessarily to educate you. They're in business to get you to watch. There is a big difference between the two. That's why you hear words like crash and sword and doom, because these harsh terms make us emotional, and they make us more likely to tune in to get the rest of the information so that they can sell more ad space. And I get that. The reality is, though, sometimes the information, you take half of it and you run off, as they say, with the gun half cocked, and you make a mistake. So when I read the article, fortunately, I have enough experience to say, what's the whole picture here? The reason this particular owner had sold so much of his stock was it was restricted up to a certain date. He couldn't sell it before then. You always hear me talk to you about asset allocation. You also hear me talk to you about investment policy statements, not having too much money in one particular asset. When you start a company and it turns public, you own a lot of it. You're the majority owner. People are buying it. It raises the value. So most of the time, you're restricted as to when you can sell it. When that restriction period comes off, regardless of how the company is doing at that moment, it's normally doing better than when you first made it go public. So you're selling at a gain, even if the stock has been getting its butt kicked over the last 6 months. So that's what this founder did. He sold stocks at a gain. What the article didn't tell you was that he still owned hundreds of millions of dollars of the company because he still believed in it. Me doing more research let me know that. Plus, I didn't care either way. I was already, as they say, pig committed. I was going to ride this out. But now the stock has rebounded. It has doubled since that article came out, which is my point. The point of today's whole speech is what the news prompts us to do. There's a saying, Mike Leslie came on here a couple of weeks ago. Shout out to Mike Leslie. He said Warren Buffett is famously quoted for saying, when the people are being greedy, you should be fearful. And when people are being fearful, you should be greedy. It's a contrarian approach, but it's one that I do subscribe to, because the reality is that, unfortunately, stock markets do not move based on the fundamentals of the company that the stock price is supposed to be reflecting. The stock price is a reflection of what you and I think of the company. Me and you aren't always the most knowledgeable people in the world. So sometimes stocks can be priced at a price way, way higher than the company is worth, because the general market believes everything is great about this company. Conversely, there are companies that are trading way below the value they should be trading at because we believe things aren't as good as they actually are. So you have to look at the fundamentals of the company, compare them to your long-term goals, and make a decision. When you see something that is underpriced, when you see a stock that is $40 a share, but when you look at the company, you say this should be trading at $55 a share, that's an opportunity. So market troubles, when the market goes down. So there's two things that we talk about when the market goes down. There is a correction, and then there is what is known as a bear market. Keep in mind, these are just terms that somebody a very long time ago said, this sounds like a good idea to call this. A market correction is anytime the market goes down 10%. They do not associate a time frame with this. We've seen markets go down 10% in one day. We've seen it go down steadily 10% over a year. But a 10% drawback from the height of a market is called a correction. If it goes down, and this number varies depending on who you'll talk to, 15 to 20%, then we are in what is called a bear market. Now, the term bear market would make you think that this is a market that will be low for a while. But let's just go back as simply as recent as March of 2020, last year. We had a 30% drop in the S&P 500 that took place over 2 days. By definition, that's a bear market. It was over 15, 20%. But it literally turned around and spiked back up a week later and took off. So can we really call it a bear market if it was a week long? I would say that's a correction, a very, very steep correction. So for my big tank definition, and I always put myself on the line with my own knowledge, I call a correction anything that's over 10, 15%, that's short term. A correction is, hey, the market's a little pricey. This stock is a little pricey. Let's knock it back down, to where it belongs. But then it can start increasing again from there. A bear market, you should, put your coat on. You should buckle down. That's going to be a while. That's going to be the market not making you money for a lengthier period of time. And it can be lengthy from a month to a year and a half. Bear markets can go for some time. The great news for all of us is that there has never been a market correction or a bear market that has not been followed by a bull market. So I guess it would be a good time for me to talk, because I always want to make sure my audience knows what I'm saying. Bull market, bear market. Bull market, straight up, things are going good. They say the running of the bull, Merrill Lynch's emblem is a big bull. If you think about things charging hard and going forward, that's a bull market. That's good. Bear market, think hibernation, cold, everything is kind of grizzly. Bear market bad, bull market good. So there's never been a bear market that has not been followed up by a substantial bull market that takes the market to new heights and new levels. The question you have to ask yourself is, can you handle these ups and downs? Have you educated yourself enough to understand that good times and bad times come hand in hand? Have you set up a plan that lets you know, hey, you know what? This money is not needed next Thursday. This money is needed in 20 years, 30 years, 35 years. And over that time frame, I've seen the research. I see what happens. I'm good. And do you have someone keeping you on focus, checking you? It doesn't always have to be Wealth Our Way. It can be any trusted resource where you can go to and get updated information as to what is going on in the market. Doesn't necessarily need to be CNBC or MSNBC, these people that, get paid to sensationalize the news. Get sound financial information. Understand that bear markets come and bull markets come, and you can make money in both if you have a plan. I'm a big fan, as you know, of dollar cost averaging, taking a set amount of money, putting it into the market every month, every quarter, every year, whatever works best for you. But the reality is that you just have to have a plan, that you have projections. So when I sit down with a client, I talk to them about what their financial goals are. What is your income need when you're in retirement? What number do we have to get to so that we can safely draw down from that number to meet your income needs? If we know what that number is, now I can back into how to get there based on what return you're comfortable seeking and how much money you have. And then I sit down and I tell the client, hey, your goals are outlandish. You want to retire in 2 weeks with $1 million and you got 34 cents right now. We can't do that. But if you want to retire in 20 years and we can get that 34 cents to look more like $250 and we can put it away every week, I can get you to that number you're trying to get to. But along the way, we're going to have good times and bad times. The number one way to set a plan off course is to not follow it. When times become bad, to get scared and say, I don't want to do this. I'll wait till it gets better. That's the kiss of death to any plan. Market trouble is not a time to get out of your plan. Market trouble is a time to revisit your plan, make sure everything is still on track, and stick to the plan. If not, battle down even more and average down with more investments in it. So with that being said, I wish you guys all a happy Wednesday. My name is Charles Tank Harris. This is Wealth Our Way. And remember, wealth is not only for the wealthy. Have the best day.